The title of my presentation is Financial Future. My hope is that I might be able to provide some introductory information that could help people in the future setting themselves up financially. It's especially geared towards medical residents, but there's lots of information that's pretty globally applicable to everyone. Just some extra caveats for people who might have high loan debt or be a future high income earner. So I'm Joel, I'm a family medicine resident. I don't have any special training that qualifies me to talk about finances. But I feel like it's one of the shortcomings of our medical school training is that we just don't get this information formally. And then in residency, we don't get it until the practice management course third year. So I'm hopeful that my stumbling through it might be beneficial to someone. It's a sort of long presentation, like 50 slides. I think it'll take an hour or so. But I decided to record it so it's easier for people to pause or fast forward to sections that might be interesting, or you could just not watch it at all or skip around. I realize it's not interesting or needed to everyone. And I welcome any kind of feedback, and we'll be glad to have a follow-up discussion if people are interested. It'd be helpful for me to get feedback actually, so I can edit the presentation if I ever do it again. This slide is just disclaimers. I made this talk because I genuinely enjoy reading about the material. I thought it'd be fun and nice to share with my friends. My intention is to be as objective as possible and without bias. I hope to just define what a stock is and not tell you which ones I buy or think you should buy. So I have no actual or potential conflict of interest in relation to this presentation. This presentation is not a recommendation of any investment strategy or advice to buy any particular security. It is not intended to serve as sufficient advice for any investment decision. All investments run the risk of lost principal. Do your own research and seek out a professional for help beyond your scope of knowledge. So I'm covering a lot of topics. I think they're all very important. I won't go into a ton of detail regarding any one thing, but I will at least hit on high yield material. I'm presenting in chapters that are all listed here, so you can skip around to find topics that are interesting to you. So first, let's talk about taxes and inflation, the biggest expenses you'll face over the course of your life. Something I learned about later in life, and I'd like to admit, is how federal income taxes work. What does it mean when someone says they fall into a 32% tax bracket, or their marginal tax rate is 24%, or their effective tax rate is 22%? It all kind of was muddied together for me. So this table represents tax rates for 2021. People are taxed differently depending on their filing status. So that's one perk of being married. If you and your spouse file jointly, you pay less taxes than a couple filing separately or a single person. I want to go through a quick example, which is written out on the right side. So imagine a single person, let's find that column, whose pre-tax income is $225,000. So $212,600 of that is taxable with a standard deduction. As there's many other types of deductions that people utilize, but for simplicity's sake, we won't go into all those. Looking at the table on the left, we can track down the single column and see that $212,600 falls in the 35% bracket. Notice that this income just barely falls into the 35% bracket. So maybe that person would be better off with a few $1,000s less in taxable income, so they could be in the 32% tax bracket. But that thinking's wrong, because not all of your money is being taxed at the maximum marginal tax rate. So going through my example on the right, the first $9,950 is only taxed at 10%. The next $30,000 is taxed at 12%. $45,000 after that is at 22%, then $78,000 at 24%, $44,000 at 32%. So only $3,175 is taxed at 35%. So when you take the weighted average of all that tax, you get your effective tax rate, which in this case is almost 22%. And of course, in addition to this, you have FICA tax, which funds Social Security and Medicare. And in most states, you also have state income tax. These two taxes end up being about 5 to 6% each, in addition to the federal tax, which brings up another point, actually. A few states have no income tax, and it's worth looking at how tax-friendly a state is. Say you're looking for work in the Cincinnati area, and you have offers in Ohio or Kentucky that are identical. It would be good to know each state's tax structure. So another type of tax is capital gains tax. This is an extra tax on realized profits of your investments. Now, there are tax advantaged accounts like retirement accounts that I'll talk about later that are not subject to this tax, but those accounts have contribution limits. So you'll likely put lots of savings into a brokerage account, which is subject to this tax. Remember, you only get this tax when you sell an investment, which is what makes a profit or loss realized. You can have holdings in a brokerage account that increases in value every year and hold them for decades, even without ever paying this tax. But whenever you sell, you'll be taxed on the profits. It's generally advisable to hold your investments at least a year so that you qualify for long-term capital gains. This will make the tax less, as shown in the chart on the left. The amounts shown in the table represent your other taxable income, including gains. So if you take profits in less than a year, like day traders or swing traders, that gets added on like normal income, which is taxed at a higher rate, like what was shown on the previous slide. Collectibles like baseball cards, coins, precious metals, antiques, fine art are all taxed at 28%, regardless of your income level. Some investors may get an additional 3.8%, which is called the net investor income tax. That's a more nuanced detail. It's not really critical to know right now. But remember, investments also can lose money at times, and that helps you from a tax perspective in offsetting the gains from your more successful investments. If these losses are more than your gains for the year, you can even carry those losses into the next year to offset profits from the new year. If you've ever heard of tax loss harvesting, that's basically what it means. For residents who probably don't have a lot of capital in their brokerage account, or if they do, they're probably not realizing profits this early on, the biggest profit you might see is the sale of your residency home if you bought one. An especially pertinent tip for us to know is the definition of a primary residence. This is when you have lived in a home for at least 2 out of the last 5 years. Once you reach that requirement, you're excluded from capital gains tax on the sale of the home up to $250,000 in profit for a single person, or $500,000 in profit for a married filed jointly, which I'd be shocked if any resident home could really profit that much in a few years. There's lots of other ways to shelter gains in order to reduce your tax burden, but I won't get into all those strategies, mostly because I'm not experienced in them. But one to look into if you are interested is the power of real estate depreciation. It's something a lot of wealthy people use to get wealthier. There are even more perks if you or your spouse are able to qualify as a real estate professional, which is why it's common for rich people to have a partner who gets involved in real estate enough to earn that title. It's not the same as being a real estate agent. The tax benefits can far outweigh the salary of a decent full-time job in certain scenarios as a real estate professional. Now, I know everyone understands inflation, but I think it's important to explicitly talk about how it affects our money. So using the dollar values on the table on the right, I'm going to give a quick example of the power of inflation. Imagine somebody in 1980 puts $100,000 into the bank. If that money sat safely in the bank for 40 plus years and was still there now, it would still be worth 100 grand, which only gets you as far as what 30 grand would have got you back in 1980. So even though you didn't lose money, you lost a lot of value. Now imagine a person back in 1980 was a bit more savvy, and they put that 100 grand in investments that return a modest 5% growth each year. Compounding that growth annually would turn that money into $776,000 today. Anybody keeping a large amount of cash in their bank account right now should be questioning what their intentions are with that money. Sometimes it makes sense if you're planning to make a large purchase soon and don't want to expose that money to volatility or of some investments, but generally the money is losing value every day just from inflation. In order to break even, your money needs to at least grow annually at the rate of inflation, which is usually a little more than 2%. Now, the flip side of the coin is that your debt is also decreasing in value. A perfect example is the COVID loan forbearance. For the last couple of years, we've benefited from an interest rate that's less than inflation, which means even though the dollar amount of our debt is the same as 2 years ago, the value of that debt is less because the value of the US dollar is less now than it was 2 years ago. Without getting too much into the politics, I think it's worth noting how inflation affects certain populations of people. It's true that generally inflation stimulates economic growth by creating more money, which equates to more spending, but it disproportionately negatively affects lower income people and worsens the issue of poverty. The dollar store increasing prices to $1.25 impacts a person who is below the poverty threshold much more severely than how it inconveniences a wealthy person. Next topic is investing. This is one of my favorite topics and one of the longest topics. There's a lot of terminology to discuss. So securities are some form of a financial investment that has fungible monetary value. The one you probably hear most about is stocks. You can only buy stocks in public companies, and each stock represents a tiny share of that company. There used to be little tiny fees when buying stocks, but nowadays no mainstream brokerage would charge you extra. An example of a stock is Netflix or Apple or Home Depot. Most big companies that you commonly think of are public and sell stock, but not all are. Wegmans, for example, is private, so you can't buy their stock. A bond is when the money you spend goes to some entity that needs capital and agrees to pay you back at a later date, plus a little extra. These are generally considered to be more stable investments, but without room to have very large returns. Some bonds are corporate and some are through the government and are considered very secure. A mutual fund is comprised of multiple securities within it. It's like instead of buying one flavor of ice cream, you buy all of Baskin Robbins, you get a little bit of each flavor. Some financial experts put this portfolio together and they charge a small fee called an expense ratio in order to maintain it. The fees for mutual funds tend to be a bit more than some of the next options I'll talk about, because mutual funds are usually actively managed, meaning somebody's buying and selling the entities within it, so you're paying for their work. An exchange-traded fund, more commonly referred to as an ETF, is similar to a mutual fund in that it is made up of a portfolio of securities, but it's usually passively managed, which means it doesn't really change and there's not somebody adding and subtracting from it all the time. So it has a lower expense ratio. Some ETFs are based off of a stock index. An index is comprised of all the stocks in a certain market. The S&P 500 is an example of an index, or the NASDAQ and Dow Jones are both indexes too. You can invest in an ETF that includes a little bit of stock from all of the companies within one of those indexes. That way, if an individual company goes bankrupt, it does not hurt you too much because you have your eggs spread out into many baskets. Similarly, if one stock skyrocketed in value, that also doesn't increase your overall worth by a huge amount. These tend to be pretty stable funds in the long run and reflect the overall economy's performance. The last box has a red square around it because it's especially important, especially for residents who do not have a lot of extra money to put into the other securities. Everyone watching this lecture should have an emergency fund already. An emergency fund is exactly what it sounds like. If you all of a sudden have a large expense or you all of a sudden have a pause in income, you need to have a pool of money to cover yourself. This money should immediately be accessible, and the general advice is for it to cover 3 to 6 months worth of your living expenses. It doesn't need to replicate your income, just cover expenses. There are different approaches as to where to keep the money. Lots of people keep it in a simple checking account. Some hold cash hidden in the house. Others use a credit card that holds them over until they can free up money elsewhere to pay off the credit card. It's important to have one of these immediately liquid options so that you do not suffer the penalties of pulling money out of other accounts. I'll talk about some of those accounts later on, like 401k, IRA, HSA. They all have rules about when and why you pull money out. So you generally want to follow those rules. Something else I'll talk about later is disability insurance. If something serious happens and you can no longer work, hopefully you have disability insurance. Your emergency fund needs to be enough to hold you over during the waiting period until that insurance kicks in, which again is typically 3 to 6 months. This is a quick slide to compare and contrast stocks and bonds. I think the biggest difference to know is the volatility of each. As I mentioned before, a stock gives you equity in a particular company, so the performance of that stock can wax and wane immensely depending on the performance of that individual business, as well as the economic climate as a whole. For example, if you invested in Penn National Gaming at the start of 2021, you would have lost 43% of your money by the end of the year. On the other hand, if you invested in Moderna, you would have been up 143%. This is putting all your eggs in one basket and means you're exposing yourself to a lot of volatility if you don't diversify. Even though one year could be really good or really bad, stocks tend to do well in the long run, and the average annual return over the last 100 years is about 9%. Bonds, on the other hand, are a lot lower risk, but also lower reward. You know the terms of the bond when you buy it, so you know how much money to expect to make. The yield from bonds depends. The yield from bonds depends less so on the economy and individual businesses and more so on interest rates and inflation rates. The annual returns for these tend to be around 4 or 5%. Asset allocation is a really important decision to make before picking investments. A lot of the factors in deciding this are personal, and so universal recommendations don't apply to all people. Everyone has a different risk tolerance. Some people are able to gamble and lose money and not be too fazed by it and be comfortable earning it back later on. And for other people, that would give them crippling anxiety. You need to think about what your risk tolerance is and how you would react in a bear market. Would you be able to endure it and let it pass, even if it takes a few years? Or would you panic and sell everything when the market's low and miss out on that buy low opportunity? Quick sidebar to point out some terminology. Bulls thrust their horns upward, while bears swipe their claws downward. Your time horizon is another critical factor. This refers to how long you plan on holding on to investments until you need to cash in and use the money. Residents are typically at an age where their time horizon is 20 plus years. So if there's a downturn in the market, they're able to wait it out and in the long run should do well. If your time horizon is just 3 years and the market crashes, but you need the money, you could end up with a big loss. You can have a different time horizon for each account and invest accordingly in each one. In your retirement account, for example, you might have a long time horizon compared to a brokerage account with money that you're planning to use to buy a house in a couple of years. The psychological component is something I already touched on. Some investors get excited by a bear market because that means stocks are on sale and they can buy low. Other people get freaked out and take the loss because they're worried they could lose more. I and many other people can attest that it's hard to know your reaction until you have actually gone through this and watched your money disappear. The general rule of thumb is that the longer your time horizon is, the more stocks you should hold, and the shorter your time horizon, the more bonds you should hold. One trick is to take your age and subtract it from 110. The answer is what percentage of stocks you should hold. This is a very simple trick and doesn't account for how you're diversifying your investments in mutual funds or ETFs. Here, I wanted to talk about some more factors to consider when picking investments. I already talked about risk and time horizon, so I won't beat that dead horse. The next thing to consider is diversification. Even within the umbrella of stocks, you can greatly diversify what you're holding. Try to consider various economic sectors since they can have pretty different performances. If all your stocks are Google, Amazon, Microsoft, Facebook, and other tech companies, if one of those is doing poorly, there's a good chance that others will do poorly as well. So it'd be a good idea to also have some stock in an energy company or healthcare or lumber, etc. There are also large and small companies. For a small cap stock, think of a company worth hundreds of millions. For a large cap stock, think of bigger companies worth tens of billions. Another term is a value stock. These tend to be older companies that are not expected to greatly change. They're a better deal to buy with shares being appropriately priced according to the company's value, but they're not expected to have huge returns. Some of these pay out a small dividend, which is a kickback you get for holding their stock. Common examples of value stocks are large banks like JP Morgan. The growth stock is a company that has a better shot of beating the overall market, usually new technologies or leaders of their sector. Their stock may cost more than the company is actually worth because their future growth is priced in. A common example of growth stocks are tech companies like Tesla. The next modifiable factor that I encourage people to consider is expenses. Unfortunately, a lot of people who work in finance make their money through the fees they get from managing clients, not because they have successful investments. I'll talk later about how to choose a financial advisor. It's not uncommon for someone to pay 2% in fees alone, maybe 1% of assets under management to a financial advisor, and then another 1% for high expense mutual funds. This is how a lot of people invested in the 80s, and financial advisors did very well because they got kickbacks for getting people into certain mutual funds. In the 21st century, ETFs have been largely replacing mutual funds because they give investors the same market exposure with less fees. Common expense ratio for ETFs is 0.1 to 0.5%. Some of the ETFs that track a stock index are as little as 0.03%. If two investors make 8% per year, the one loses 2% of fees and the other pays 0.1% in fees. After 30 years, the second investor would have 70% more money than the first. That's $98,000 versus $50,000 with an annual investment of just 10 grand. The last point is tax efficiency. I'll talk a lot more about this when I go over some of the different types of investment accounts. Taxes are a huge expense, and so tax deferred accounts should be fully utilized to reduce future tax burden. This is Jack Bogle. He's a founder of the Vanguard Group and is credited for creating the first low-cost security that tracked a stock index, also called the index and chill strategy. His proposed method is one that is extremely low in fees, has good diversification, and is easy. The only decision to make is what ratio of stock ETFs to bond market ETFs and domestic versus international exposure. Jack Bogle is also a fan of dollar cost averaging. This is when you buy more positions periodically, sometimes buying at a high point, but other times utilizing a low. This method can be even further simplified to a single holding that is automatically purchased every month. Vanguard has mutual funds with the same holdings and extremely low fees. So someone who doesn't want to put effort into investing their money and also doesn't want to pay for a financial advisor could take 30 minutes to set up a monthly transfer from their checking account into their brokerage account and have that auto invested into an index fund, along with any dividends being reinvested whenever available. And that's a perfectly reasonable strategy. This graph shows the stock market performance over time. The point is that in the long run, it goes up. You can look at the 80s and 90s where that generation made a lot of money from a thriving stock market after getting a dirt cheap education and extremely affordable homes. And then you can look at our generation where we went through the COVID-19 pandemic and we don't have the current crash of 2022 that's going on represented here yet, but a couple tough times. Now at this point, I'm imagining there are various reactions to the last few slides. Some people might know all the stuff and it's a waste of their time. For others, it might be new and interesting and exciting. For others, it might be scary and overwhelming. Maybe I've inspired someone to learn more. Maybe people just want a financial planner to do all this for them. So if you want to hire a financial planner, make sure to know what you're getting yourself into. Some are great, but there are plenty out there that are predatory too. One of the most important questions is asking how your advisor gets paid. Flat fee is the best way to pay without having a conflict of interest. Flat fee and hourly pay the advisor the same amount regardless of what advice they give you, so they have no reason to give bad advice. An hourly rate is not horrible, but advisors are expensive, at least $200 an hour, and can take their sweet time and be more active than what's necessary. The opposite end of the spectrum is a commission-based payment system. With this style, you pay a percent for assets under management, which incentivizes the advisor to keep money conservatively invested and discourages withdrawal or paying down debts. It also can be a large fee for very little work, over 1% assets under management for funds that aren't even actively managed. Almost all advisors can get commission for buying certain funds, and sometimes crappier mutual funds have higher commissions. An advisor that wants to buy all A or C share mutual funds is a red flag compared to an advisor buying no load mutual funds or ETFs. And then less than 3% of all financial advisors are actually fee only. The terminology can be confusing because fee-based is not the same as fee only. Fee-based is a combination of flat rates as well as commissions. Trust is crucial for total transparency. You need to feel comfortable asking questions. They should have no problem explaining fee structures and compensation they receive. They should get to know you as an individual and understand your financial goals. A lot of times they have canned investment ideas that they just give to every single client who comes in rather than understanding what you're trying to accomplish. And look for someone who's a fiduciary. This means they have a legal obligation to give advice that serves you best. The contrary is suitability standard of care, which requires that they give you advice that is technically reasonable, though it might not be the best. For some people's situations, hiring a financial advisor certainly makes sense, but for many people, it's not necessary if you're willing to spend a little time learning the basics. Being charged a 1% fee for all assets under management by an advisor is pretty standard. This comparison shows how amplified that fee can get over the years. In this example, imagine a doctor who invests $50,000 per year starting at age 30 and continuing until retirement of age 60. If they get a 5% annual return and manage this alone, they'll end up with almost $3.5 million. If they had an advisor all the time, they would have $572,000 less, which means they paid their advisor $19,000 per year. The topic of insurance is a little bit more on the dry side, but absolutely necessary to know about as a resident, and it's a very common time to purchase certain policies. I'm actually going to keep this section fairly short and just focus on life insurance and disability insurance. Our employer takes care of malpractice insurance, but that doesn't protect us from running into litigious people outside of work. Once on an attending salary, an umbrella policy with limits of $1 million to $5 million is reasonable. Residents can hedge their bets now by increasing liability limits on their auto and renters or homeowners policy to between $300,000 and $500,000. The first type of insurance I'm going to spend most of the time talking about is disability insurance, specifically own occupation. This means it's a policy that protects your ability to perform a particular job. So if you're a surgeon, you would collect disability payments if you injured your hand and could no longer do surgery. This doesn't mean you cannot work another type of job. You could leave surgery and collect your disability payments every month, but then still go work full-time as a device rep or consultant or any other career, even a different medical specialty. A few points to consider about this type of insurance. First, it's optional. Like many forms of insurance, you might end up spending thousands of dollars on it and never use it, but it's also possible that it'll be worth the premiums many times over if you do end up disabled. I like to remind people that the best outcome is that you never use your insurance. You don't necessarily want to be disabled. The same reason we buy auto insurance. We don't want to crash our car, but we protect ourselves just in case. So the first point on the top left there is that it must be purchased through an agent. You've probably received dozens of emails from agents offering own occupation disability insurance. They're trying to get that commission, which is okay because we have no choice but to buy these policies through a qualified agent. What's important is to find an independent agent that has no extra incentive to get you to purchase your policy through a certain company. There are other agents affiliated with a single company that would not show you all your options. It's kind of nice. There are only 6 companies that offer own occupation disability insurance, so it's easy to get quotes from all of them. And there's actually only 5 companies that offer it in New York State. So I'll show an example of the 5 different companies on the next slide. This insurance is expensive. Even as a resident, it can be a couple $100s per month. What's good for us is that family medicine is one of the least expensive specialties to insure. It's because we don't make as much money as specialists, and it's harder to get disabled enough to be unable to work our job compared to someone like a surgeon who may be out of commission just because of a common tremor or some vision changes or a hand injury. And there's a significant discount when buying a policy as a resident rather than as an attending. So it's pretty common practice for this insurance to be bought in residency. It's also cheapest when you're young and, in theory, healthier. It's also cheaper for men because men are less likely to get disabled than women, which is the opposite for life insurance policies because men are more likely to die than women. The hardest part about this policy is understanding the riders. So there's lots of different riders that can add to the cost and tinker with the details of the policy, and they're all optional. So you have to take the time to learn about all the different riders and to get quotes after adjusting your preferences. But a few of the riders are pretty crucial, which is what I want to talk about on the next slide. First of all, before I get into the riders, is make sure you know what the definition of disability is for your specialty defined by the company you buy your policy with. So as for riders, the first one to know is COLA, which stands for cost of living adjustment. This makes it so that your payout keeps up with inflation. Without it, you could get disabled now and be stuck at your current income for the next 30-ish years, even though that money will constantly be worth less and less. The next rider is the future purchase option, which allows your youthful, pristine health to persist on paper, whether it does in real life or not. You can increase your policy coverage as an attending without going through underwriting again. It's really important because the insurance companies will find anything they can to hold over your head. Just going to the doctor for back pain before your policy begins may exclude MSK issues from being covered on your policy for a certain number of years. Some pre-existing conditions could disqualify you entirely, greatly increase your premium, or decrease the period of time they'll pay out. Most policies pay until age 65, but they could structure your policy to state that for disability related to a pre-existing condition, they'll only pay for 5 years. Before I got my policy, I only went to the doctor one time in order to put on record that I had no complaints. Then for the underwriting process, I could verify that I saw my doctor, had no diagnoses, needed no medicines, had no abnormal labs, etc. And the underwriting process for me was just a 30-minute phone call survey. For my wife, the process was multiple weeks of collecting old medical records just because of some labs she had done when she was really young. The last rider I'm mentioning is residual disability, which is like partial disability. If you're disabled to the point where you're unable to work full-time or see as much volume so that your income drops by at least 15 to 20%, then you can get partial disability to make up that difference while you keep working. This would be a good slide to pause and read through. It shows some other riders and policy details in each row. Each column represents one of the big 6 own occupation companies I mentioned earlier. This policy is an example of quotes I got as a 29-year-old male family medicine resident without significant past medical history. And these policies usually pay 60 to 80% of your previous income. But remember, you're free to find another job while collecting your benefit. To collect benefits on any occupation policy, you have to be disabled to the point of being unable to work any job at all. To collect on an own occupation policy, you have to be disabled in a way that prevents you from working in your current job and current specialty only. Again, this means you can collect full disability and work full-time in the second career as anything other than a family medicine doctor. You can even work in a different medical specialty, like a disabled neurosurgeon collecting a full neurosurgeon salary, and then working a full-time job as a neurologist, collecting a full neurology salary on top of it. Another slide to pause on briefly. This shows the itemized cost, including cost of each optional rider selected in this example. You can add or subtract to fit your needs. The insurance agent selling your policy should be able to help guide you. They'll work for you to earn your business that you can buy the policy through them. Here are more examples, but for a healthy 29-year-old female orthopedic surgeon, the biggest difference is that these policies are at least $100 per month more than the previous example. This is because females are more expensive to insure and orthopedic surgeons are expensive to insure. The next relevant form of insurance to consider is life insurance. This will be critical for some people to purchase and not necessary for others. To think about it simply, if your income all of a sudden went away, would you have loved ones who suffer financially? Maybe children that depend on your income, or a partner, or even parents that need financial assistance? If your death would not be financially harmful to someone, then you probably don't need life insurance. Now, there are different types of life insurance, and I'll briefly discuss a few that you'll hear about most often. First, whole life insurance. To be blunt, it's generally a bad idea. I can't think of when it would make sense for any resident, especially. One reason why people tend to dislike whole life is that you don't necessarily need life insurance forever. Eventually, you'll probably have a high enough net worth that you're self-insured and you have money to leave behind if you were to die, therefore not dependent on an insurance policy. Second, the policies cost a lot of money, and most people actually end up abandoning them and being out the money with no more insurance benefit. There are cases where whole life insurance can be worth investigating, but that's usually for people with a very high net worth that might use it as an investment vehicle or for estate planning, neither of which are usually considerations for a resident or even young attending. The next type of life insurance is universal life insurance. It's very similar to whole life and doesn't warrant a more in-depth discussion. Both of these types of insurance make the agent who sells them a lot of money and are often what spurs the sad stories of predatory agents taking advantage of people who don't know any better. So just be cautious if someone approaches you recommending whole life or universal life insurance. By far, the most common type of policies are term life insurance. This is where you define the amount of coverage and the duration of coverage, and it's very simple. You could say you want a policy that pays out $1 million when you die, and you're willing to pay for that policy for the next 10 years. These policies are actually quite affordable. And the strategy I wanted to introduce is laddering multiple policies. The main idea behind laddering policies is that you need the most coverage early in your career before you have had time to build up your savings and other assets. Then as you amass wealth over the years, your family will rely less on a life insurance payout since they have savings to live off of. And eventually you might not need any policy at all if you become financially independent. Now, if you focus your attention on the graphic on the bottom right, it demonstrates how laddering term policies would work. The idea is that you would buy several different policies that have a different duration. In this example, there are 3 different policies for $1 million each. So if this person were to die in the next 15 years, their payout would be $3 million. Now, say 15 years have gone by and they have built up some good savings. They don't need as much insurance anymore. So that first policy drops off. And now they will get a $2 million payout if they die in the next 5 years. Now, thankfully, they're still alive and they again have built up even more savings over those 5 years and they need even less insurance. So they're left with the one inexpensive $1 million policy that will last them another 10 years. Fast forward 10 years, and now they've been working for 30 years and have reached financial independence. So their last policy can fall off, and that is fine because they no longer need it. With physician salaries being what they are, you could realistically ladder a 5-year, 10-year, and 15-year policy instead of following the 30-year plan showed here. Talking about debt is probably my least favorite topic in the talk, but again, it is important. I hope you don't have any debt and can fast forward through much of this section, but for most residents, this conversation is very necessary. Most residents are already enrolled in a repayment plan, probably pay or repay. Both are actually really good options. I've listed some of the key differences on the slide here, but I want to take a minute to stress the importance of the bottom line that talks about interest subsidies. Both plans have a government subsidy that pays all interest on subsidized loans for the first 3 years. Sounds nice and all, but the federal direct loans that almost every medical student used to pay for medical school are unsubsidized. So you may have some old subsidized loans from undergrad, but I strongly recommend you log into your loan servicer website to view your loans. For me, for example, I have 95% unsubsidized loans, so the government paying off interest on my tiny subsidized loan is a negligible amount. What makes repay extra enticing is that the government will also pay off 50% of the unpaid interest accrued on your unsubsidized loans throughout the life of repayment. That could be a big help for someone who has high loan debt, especially when as a resident, your income is so small that the 10% of discretionary income paid each month is not enough to cover interest accrued. This is an important detail, sometimes called the tax bomb, and can add hundreds of thousands of dollars to your perceived income as far as the IRS is concerned. After making the minimum payments for pay or repay for 20 or 25 years and accruing interest throughout that time, some people will end up with $500,000 in loans forgiven. Whenever that happens, you're going to get taxed on that huge amount as income, and you'll be responsible to pay that tax bill immediately, or else you have to enroll in an IRS repayment plan at about 5% interest. For the next few years, there's no tax bomb thanks to the Biden administration, but that's not expected to last past 2025. Time will tell. The forgiveness earned through public service loan forgiveness is not taxed, and I'll talk about that program now. So public service loan forgiveness, commonly referred to as PSLF, is very popular. It's only for federal direct loans, no private loans. If your loans were once federal and you refinance them to a private lender, you're disqualified from PSLF. I'll talk more about refinancing shortly. Your employer must be a not-for-profit or a government organization like US federal, state, local, tribal, or military, and you must work there full-time. Something that's important to ask when seeking a job is to ask the status of the company that issues your pay stub. It's possible to work for a hospital that's a 501c3, but be paid by a company that is not. I remember interviewing at a residency program where that was the case. Even though their hospital is nonprofit, the residents in that program didn't qualify for PSLF credit for their loan payments all through residency. The last requirement for PSLF is that you make 120 payments while under an income-driven repayment plan, like pay or repay. And you should fill out an employer certification form annually, which I'll show you on the next slide to ensure you're meeting those requirements. There have been lots of criticisms of PSLF, and it's well known for being a horribly run program with all kinds of headaches for borrowers, but the rules are actually pretty simple. There's always news of the rejection rate being something like 98%, but almost all of those people who applied did so incorrectly. And that data was from very early on when forgiveness just began, and the rates are very different now. The difficulties are from the 2010 era. There used to be very few direct loans and difficult to understand the repayment program. For example, IBR is from 2009, pay started in 2013, repay started in 2016. So for someone to have been approved by now, which takes a minimum of 10 years of payments if they're paying every single month, they would have had to understand the details of PSLF in the very early first few years. But the number of people getting approved is growing exponentially. There are also rumblings that PSLF might go away at some point, though it's so far just hearsay, and especially wouldn't happen under the Biden administration. But the prevailing expectation is that if PSLF does go away, anybody who has already begun the program will be grandfathered in, which is even more reason to fill out an employer certification form now. This is the form that should be filled out to certify your payments. It's a quick form, and you just have to hand it to Sue DePasquale, and she will get the necessary administrative signatures and submit it for you. Even if you think you will work privately and not pursue a PSLF, I still encourage everyone to fill out this form and get credit for the 36 payments you make in residency, just in case you end up in a public job and still want the option of PSLF. Also, you don't have to make sequential payments. You could go work a private job for a couple of years and then end up back at a nonprofit and start making qualifying payments again, as long as you still haven't refinanced. It's recommended to fill this out every year in order to certify those 12 months of payments and have them added to your tally on the Fed Loans website. Technically, you don't have to fill this out annually, and you could do it at the very end of residency for all 3 years. But then if there are issues, you're finding out about them late, it's good to check in along the way and secure credit for those payments. On one of the pages, you'll have to enter an employer address and identification number, which I wrote out there on the right. You can find this on your W-2 form. After you send that last form in, Fed Loans will respond to you with your payment count, which looks like the table shown here. This is straight from my account, so consider that proof that our residency is eligible for PSLF. This shows I have been credited for 19 payments, even though I'm eligible for 23. It's because at the time I submitted the employer certification form, I had 19 payments made, but then it took Fed Loans 4 months to respond to me. And so by the time I got this back, I had 4 more eligible payments that I'll get full credit for next time I submit the employer certification form. So I've mentioned refinancing a couple times. Refinancing loans is a big decision and forever disqualifies you from PSLF. So let me first clarify some terminology. It's important to understand the difference between consolidating and refinancing. Almost everyone consolidates their loans after graduation from medical school, and that doesn't change the type of loan. It just simplifies the various loans into one payment. Refinancing is when a private company buys out your loan and becomes your new lender. If you focus on the top left box on this slide, I'm going to walk through some points to keep in mind. Again, if you are pursuing any kind of federal forgiveness program, don't touch the idea of refinancing with a 10-foot pole. This includes the COVID loan forbearance. If you had already refinanced, you wouldn't have been getting any of the pause in payments for the last 2 years. If you have a low debt to income ratio, it's less likely that you'll ever reach forgiveness. For example, if you only have $150,000 in debt, but you make a neurosurgeon salary, that makes it so that paying 10% of income with an income-driven repayment plan is enough to gain on the principal and actually pay the loan off before it's forgiven. And if you're not getting forgiveness, you might as well pay it off at a lower interest rate, which is why you would want to refinance. So when should you do it if you are going to do it? The short answer is probably as soon as you become an attending. While in residency, you won't qualify for very competitive rates. And since your income is still relatively low as a resident, it's best to make small payments and collect the pay and repay interest subsidy, and then refinance after graduation when your income jumps considerably. Effective rate is what your interest rate actually comes to after factoring in the subsidy. So if your rate is 7%, but you only pay a few $100s, which barely makes a dent in your interest accrued, the repay subsidy will pay a half of that remaining interest and bring your effective rate closer to 3.5 or 4%. That effective rate will go up when you make more money and therefore pay more of your loan and therefore have less unpaid interest each month. So as an attending, you could refinance from the federal rate of around 7% down to closer to 3 or 4%, depending on what the economy and interest rates are like. And remember, it's not a one and done situation. You can keep on refinancing if better rates are available, which leads me to the next topic of cost. There are actually lots of incentives given by the private companies you refinance with because they want to collect the interest. So you can easily get a $1,000 gift card, for example, by selecting them. Another cost that isn't a fee is just the change in monthly payment. If you go from a 25-year income-driven repayment plan to a 10-year private plan, the monthly payment will, of course, be a lot more. I mentioned earlier that refinancing disqualifies you from PSLF. And like I said earlier, you would forfeit federal repayment holidays, which is kind of hard to predict ahead of time, but potentially could be a cost if you're missing out on the savings like the one for grants right now. In the bottom right, I listed a few of the common companies that people refinance through. Also, you can look for some affiliate links like through White Coat Investor for extra perks like more cash back. Another type of debt that some residents are repaying is their mortgage. And yes, a home is still a liability as long as it's costing you money each month through a mortgage. Eventually, it could become an asset as you gain equity in the home. Anyway, mortgages have lots of associated fees. They're comprised of many smaller costs, the details of which don't matter greatly. Many are non-negotiable, while some are. Origination charges can vary a lot and be negotiated. Lender credits are helpful at reducing some of the costs, but sometimes come at the expense of a higher interest rate. Points are the opposite. You can pay extra in closing costs for a lower interest rate. You got to do the math to see how much the lower interest rate would save over the course of the loan and if that outweighs the upfront cost of the points. A physician loan can be acquired based on a signed contract that is months down the road. So even if you have no pay stub yet, it's an option as a resident. Physician loans allow for debt to be based on minimum required loan payment instead of size of the loan. Physician loans are available to a number of other high income earners, not just doctors. Usually they waive the PMI, which is mortgage insurance that most people have to pay. And these loans also ask for a smaller down payment, like just 10%. Regarding terms of the loan, a simple 30-year loan is most common. If choosing a 30-year loan over a 15-year loan, think of what you would do with the savings. Ideally, you could invest some with returns greater than the return of paying down the mortgage rate. A 15-year mortgage with higher payment and lower interest rate could be a good option too and save you money in the long run. In certain situations, a balloon mortgage could work if you know you will be selling after residency and able to make a large payment upon completion of that sale. You can refinance a mortgage whenever you want, but you have to pay these fees every time. And even for a resident level home, that can easily be a couple $1,000s. I think this section will have lots of overlap with the third-year practice management curriculum, but I still wanted to address it. I'll talk about contracts, but also some points about billing. Before even diving into the details, let me say that hiring a lawyer who does contract review is a very normal and reasonable thing to do. If they even make one change to your contract, it'll be enough to make it worth the cost of hiring them. You can do your own negotiating, be very successful at it, but you just have to recognize when to ask for help. It's like doing taxes. Technically, we can do it ourselves, but also there are people whose entire career is specializing in taxes, and so we ask for their help when we need it. For some employers, like large hospital systems, the contracts will be standardized and with little flexibility. Other employers might be able to make many modifications. It's always worth the effort to advocate for yourself. And here are a few key components to know a little bit about. Basic term of the contract will usually be a guaranteed salary for the first 1 or 2 years while you build up your patient pool. After that, it usually switches to a production model that requires you to bring in a certain number of relative value units, also known as RVUs, which I'll talk a bit more about on the next slide. And there are lots of work perks to iron out. You could maybe even negotiate your signing bonus to be rolled into your salary, which gives you better bargaining power in your next job. Another good question is if raises are built in periodically or when your contract will be up for review. If a prospective employer is not budging on the salary department, consider other factors that are a part of total compensation, moving stipend, signing bonus, CME money, paid time off, student loan repayment. It's helpful to be aware of what kind of notice you will get before being laid off so you don't have a surprise gap in employment. And a non-compete could be a huge factor. It's very important to address specifically if you have ties to that area in which you're working. Otherwise, it's possible that when you leave the job, you won't be allowed to find another job within a 15-mile radius or more. They don't want you poaching patients from their practice if you're joining one of their local competitors is why this is the thing. Tail coverage would protect you from lawsuits after you leave. Patients may still have grounds to sue even several years after your interaction with them. The productivity model that kicks in after your first 1 or 2 salaried years is based off of RVUs, or relative value units. One component of the total RVU is the work RVU, which is most related to you as the doctor. Every single thing that you bill for is assigned a certain value that reflects how much money the hospital makes and therefore how much you make. It's supposed to reflect the complexity of that item you're billing for. So there's a list of some common work RVUs that would be encountered in a family medicine clinic listed here on this slide. You're expected to perform a certain number of these work RVUs in a year to justify your salary. And your compensation is determined per RVU. That's a number you can negotiate when figuring your salary. This is why a specialty like ortho can have higher salaries. They make a lot more money for the hospital because they can do a knee replacement in 60 minutes and get 20 work RVUs for that, which is a lot more than our typical clinic visits. There is incentive to overperform too. You can get bonus money for RVUs above your quota. There are limitations to how far this goes, but generally, if your employer has to pay you a bonus, they're happy because that means they also made more money. The figures on the top right show an example of how a salary could be determined. In this example, you're expected to produce 5,000 work RVUs annually, and the agreed reimbursement is $48 per work RVU to tally a salary of $240,000 per year. Understanding billing will play a key role in your future practice. Sports med docs who use ultrasound for every injection make more money than those who do lots of landmark guided injections. You don't get any extra money for ear lavage, but if you instrument it, even just trying briefly before lavaging, you get paid extra. After residency, you'll also be able to bill many things based on time. It's something I expect we'll learn a lot more in the practice management course and from people who have all the experience in billing more than I do. This is an actual example of a recent contract through Rochester Regional Health. Similar to the example from a couple slides ago, the base salary is calculated at 4,852 annual work RVUs multiplied by $47.40 per work RVU, which comes out to about 230 grand. That salary number is very different from total compensation though. In this example, there's also a $20,000 sign-on bonus and another $20,000 retention bonus after 1 year, as long as you stay at the job for 2 years. Regarding these types of bonuses that require vesting, keep in mind that the majority of physicians leave their first job within the first 2 years. This person already lived locally, so they were able to negotiate the $10,000 moving expense allocation to be added into their salary. They also get full benefits, 4 weeks vacation, and a generous CME fund. I don't know what limitations they have for work above their work RVU quota, but they did say that they're on track to overachieve and get a bonus for that as well. For some people, talking about salaries and compensation is taboo, but I think we would all benefit by openly discussing these topics and comparing contracts in order to help each other. I know I'm planning to talk to a lot of my friends finished residency or about to finish residency to understand their contracts when comes time for me to look through my own. I'm not going to dive into all the individual numbers here, but it's important to understand what the data means. This is accumulated by MGMA, which is Medical Group Management Association, and it's a widely utilized resource for determining physician compensation. It's produced annually and costs over $500 to acquire. I got the data shown here after sitting through an informational meeting with a financial advisor who was trying to earn my business, but it's not the most updated data. This table shows total compensation from 2019 based on geographic region. And again, this is not base salary. This includes salary, bonus, incentive payments, research stipends, honoraria, distribution of profits, etc. Something to recognize is that a lot of the contracts we're seeing here in the Northeast may be less than what we could make in the West or Midwest. Again, total compensation, this time broken down by percentiles. Good place to pause and take a look. Similar data, but expressed by how many average work RVUs physicians produced in a year. This is the last section and my favorite section probably. It's about retirement accounts. This is something that's relevant to every single person, and the earlier you get familiar with the various accounts, the better off you'll be. Again, the biggest expense a physician will face is taxes or divorce, and these accounts have lots of tax advantages. They also have contribution limits, so you can't just dump a bunch of money into them once you're attending. You want to get money in early, even if it's a small amount, so you can enjoy the power of compound growth. So this is a ranking of how a lot of people would prioritize these different accounts. So starting with the highest priority account on the top left, that's going to be your 401k or 403b match. Those are the same kinds of accounts, except the 401k is offered by a for-profit company, while a 403b is from a tax-exempt organization. This is free money essentially and should be prioritized over any other investment. It's basically extra salary that you leave sitting on the table by not maximizing an employer match. As residents at URMC, we don't get a match, which actually really sucks considering almost all other employees qualify for university contributions. But I won't get into that. Next best account and what's best for people in our shoes without a match is probably a Roth IRA. There's also the HSA that might come here. But I'm going to dedicate a whole slide to that later, but just keep in mind, this is like also a very beneficial account. So anyway, with the Roth IRA, the biggest reason to invest in this is because it's after-tax contributions. And of course, that money grows tax-free and in retirement can be withdrawn tax-free. It makes sense to pay taxes on the money now while we're in a lower tax bracket, rather than later on when we have the higher salaries and therefore have to pay even more taxes. Roth accounts make so much sense for residents, you might as well fund your spouses too, if you have one. The annual contribution limit for 2022 for these accounts is just $6,000 for people under age 50, which is why I mentioned earlier that the biggest limiting factor is maxing out the perks of these accounts is time rather than income. Even on a resident salary, a lot of people could fill up their Roth IRAs, the same as our tenants do, if you decide to prioritize that. If you fill these up and want to invest more in your retirement, you could use the 401k, 403b, again, since there's still room, even after you get your employer match. The maximum annual contribution for these is $20,500. If you want to put money in pre-tax instead of doing the Roth route, you can use your traditional accounts and pay taxes once funds are withdrawn. Remember, the money in every account on this page can be invested within the accounts and grow tax-free. That's what makes these tax-advantaged accounts. 457 is one too, but it's just for state or government employees. Residents wouldn't have a 457. The last account listed here is this in the separate box because it's technically not a retirement account. I'll explain why in a couple slides, but some people would say that this is the best retirement account and should absolutely get max contributions each year, which is only $3,650. One more thing I want to point out in this slide is that you have to actually go in and manually invest funds for lots of these accounts. By just putting money into your IRA, for example, it will sit there like a normal bank account unless you allocate these funds towards holdings of your choice. It's a super important point because some people think that all they need to do is fund an IRA or HSA and their money will grow as the economy grows. That's not the case. For other accounts like a 401k, there may be limitations as to how you can invest, and you can pick the investments when you arrange what amount of your paycheck will go into that account. This is where knowledge of the earlier terms like large cap, mid cap, value, and growth stocks will come into play. Your 401k might have an option like large cap value stock index that has a predetermined list of holdings. There should be various mutual funds like this, so you can pick what you want, but you probably won't be picking individual stocks. There'll also be options called target date funds. The target date fund is when you expect to retire. So a fund might be called 2055 target date fund because you're retiring in 2055. That option will change your asset allocation over the years, at first being heavy in stocks and then becoming mostly bonds as you near retirement. It's a hands-off way of adjusting your holdings over time to reflect your time horizon. This is comparing Roth accounts to traditional accounts. The right side is what I said makes most sense for a resident. Like I said before, those are after-tax accounts. So you pay tax now while your tax bracket is lower, then that money grows tax-free and then you pull it out tax-free. If you use tax-deferred accounts like on the left, that's traditional accounts, then you get taxed based on whatever tax bracket you're in at the time of withdrawal. The retirement age is 59 and a half years old. So you're not supposed to take any money from these accounts until then. You can take money out early, up to however much you initially contributed. But once you go beyond that and are taking out earnings, it will cost a 10% penalty plus be subject to income tax unless you qualify for an exemption. Now I listed the health savings account in the middle again because it's the best of both worlds. It's the only triple tax advantaged account. You put money in pre-tax, it grows without capital gains tax, and it's withdrawn without having to pay income tax. The question to be asking yourself is, why are we talking about a health savings account in the retirement section? It's a good question because that's not the original intention of the HSA. It's supposed to incentivize people to take care of their health by rewarding them with no taxes, which is why the funds inside an HSA can only be used for qualified health expenses. But there are several ways to use the account. The first way is as intended, which is having a steady flow of small contributions to the account from each paycheck, while you pay for each healthcare expense as they come up. You can even have a debit card for that account to pay for expenses on the spot. And ideally, the account still grows over time, but you lose out on some of the compounding potential by taking regular withdrawals. This is a perfectly reasonable way to use the account and still a good way to shelter yourself from taxes. And maybe a needed way of using the account if you have a lot of health expenses. The reason I'm talking about the HSA in the retirement section is for two reasons. One, health expenses are at least one of the largest expenses in retirement, if not the most. And it's an unpredictable figure to plan out ahead of time. As you know, the health needs for someone later in life varies greatly, which means cost varies greatly. Second reason, many people use the account as a stealth IRA in order to fund any type of retirement expense, not just healthcare. The way to do this is by saving receipts. Since I have minimal medical expenses right now, and I can afford to pay for them without tapping into my HSA, I just pay out of pocket with post-tax dollars so that my HSA dollars can compound without capital gains tax. I keep a folder of receipts that at any time could be submitted for reimbursement. If I get strapped for cash, I could submit them now and take that money out of my HSA without penalty or tax. Or I could accumulate the receipts for decades and cash out at any point later on, essentially using it as a retirement account. And if you're worried your receipts won't amount to that much and you'll have a bunch of money sitting in your HSA, that's fine. It can be withdrawn after age 65 for non-healthcare expenses without penalty, just a 20% tax, which is pretty generous considering that money had never been taxed previously. Again, essentially making it a retirement account. Another detail is that not everyone is eligible for an HSA. You can only open one if you have a high deductible health plan. Choosing what health insurance plan is right for you is another conversation entirely, but generally a high deductible plan works well for people with low medical expenses, while it may not make sense for people who spend a lot on healthcare. These are a couple additional account types that offer tax advantage growth, although they're not for retirement and they have unique benefits. The 529 plan is a common one for people with children. For this account, you pay tax on the money prior to investing it into a 529 account, but then it grows tax-free and can be withdrawn tax-free, just like a Roth account. The caveat is that can only be withdrawn for education expenses, which is why people typically let these grow over the years until their children need to fund private schooling or college. If using the money for non-educational expenses, it would get taxed like regular income plus a 10% fee. An important takeaway that is not listed on the slide here is to remember that schooling has lots of options for financing. Some parents, of course, want the best for their child, and so they put lots of money into their 529 at the cost of not having enough money to fund their previously mentioned retirement accounts for themselves. The point I'm getting at is that you can use loans to finance your kids' schooling, but you can't finance your retirement with loans. So you should prioritize your own retirement now, and then after that, add to a 529 or find some kind of balance that's reasonable for your situation. And hopefully you're able to also fund the 529, but if not, there is a lot of federal assistance to pay for schooling that is okay to utilize when the time comes. The last account I'll talk just briefly about is a flexible spending account, not to be confused with the health savings account. With an FSA, you can contribute money tax-free and withdraw tax-free for medical expenses. The reason that it's not as good as an HSA is because the funds mostly expire every year and they're not investable. An HSA you can keep after you leave a job and let that money grow even when you're no longer eligible for an HSA. But the FSA needs to be used quickly and doesn't have investment potential. It's good if you have predictable yearly medical expenses that you want to pay for with tax-free money. It's also nice that you don't need to have a high deductible health plan in order to qualify. Okay, this chart took me forever to make because I had to remember how to use the Excel formulas and charting function. What I'm showing in the graph is two different scenarios of people investing $20,000 each year for 30 years. The red curve is if you average 7% growth over that time, which would be pretty solid, but not unrealistic. The blue line is just the $20,000 times 30 years since it wasn't invested. One person will end up with over $2 million while the other would have 600,000. If in a tax advantage account, they would both pay the same taxes on that. The question that I always wondered was, how much money should I actually plan on to accumulate in order to have a comfortable retirement? The answer is essentially enough money so that the cost of providing the lifestyle you desire is largely replaced by the returns on investments of your nest egg. The commonly used rule is the 4% rule. This means your annual lifestyle costs in retirement should be 4% of your total retirement funds saved up. So for example, if you plan to live off of $60,000 per year, you'd want your starting retirement balance to be 1.5 million. The sample on this slide is if you keep your retirement money invested, assuming 5% annual return. If the market holds up and all goes as planned, You can still keep a large nest egg or even grow it since your yearly costs are less than this. The strategy allows you to die on a pile of money to pass on to your family, which is not the desire for everyone. You could also spend a lot more than 4% of your balance every year and enjoy your money yourself or donate it instead of passing it on. But obviously that's an individual decision. I've talked a lot about Roth IRAs, but a big detail I haven't mentioned is that the government makes you ineligible to contribute to this type of account if you earn over $144,000 individually or $214,000 filing jointly with a spouse. I didn't harp on this because no residents are making that much money, so this point doesn't matter until you're attending. The strategy used to get money into one of these accounts, despite that income limitation, is called a backdoor Roth IRA. There's no income limit on after-tax contributions to a traditional IRA, so high income earners can max out that account and then transfer the money to a Roth account, which allows it to now grow tax-free and be withdrawn without additional tax. There are small nuanced rules to follow when completing a backdoor Roth conversion, but it's pretty clearly explained with a quick Google search. The last thing I'm going to mention is required minimum distributions. I'm not going to get into it much because it isn't really relevant for residents, but a lot of the accounts I've mentioned require you to withdraw money from them once you're 72 years old and every year after that. For a lot of people, that's fine because they're using those accounts to fund their retirement anyway. The reason I bring it up here is because there are lots of rules depending on the account type, how long it's been opened, how much money's in it, your age, etc. And one of the rules is that you don't have to withdraw a required minimum distribution on a Roth IRA. So it's an excellent account to take to your grave and leave to an heir if your goal is to set someone up nicely with an inheritance. All right, that was a lot. I hope it was helpful. I worked really hard on it and I'm curious to hear people's thoughts. If you decided to watch all or parts of the lecture, please let me know how I could improve it. I would love to clarify things, correct something if I misspoke, field questions, or anything else that we can continue the conversation on these topics. Thank you very much for listening.